Hey, good afternoon, Kevin. How are you today?
Great to be here, Connor.
Great, fantastic. Thanks everybody for joining us. I am Connor O'Brien, CEO of O'Shares, and with me, Kevin, who's chairman of O'Shares. So, lots been going on in the markets. What do you think of the sell-off? What do you think of where we are now?
I think it's the concern, the feed versus greed, versus greed on what the economy looks like in 18 months, and it's very, very hard to know with certainty. But this is not traditionally the way you go into a recession. We're in full employment right now. Small businesses are doing very, very well. Wages have inflated, and just looking at food services, for example, a good index. The minimum wage in California is $15. You can't hire anybody for less than 21 to 25. So we're not really in a recession here. We're trying to anticipate one and having a very hard time doing it. And that's why you've got some volatility back. But the economy is very strong right now.
I mean, it's pretty unusual characteristics or circumstances that have created the inflation, caused the Fed to move up rates. The U.S. 10 years now at 3%. I remember quite a while ago. I mean, you're not the only bond forecaster in the world, but you got out of bonds so long ago, and you said, "I'm not going back into bonds. I'm not even going to look at them until the 10 years over 3%." So you were right. And today's call is not all about bonds, but what do you think now? The 10 years over 3%. You going into bonds?
No, not yet. Obviously with inflation north of 6%, you can debate why we have this inflation, whether it's supply shock or whether it's the fact that we sprinkled $4.5 trillion of free cash in the economy over basically a 36-month period. You're going to get some inflation, but sitting in 10-year duration at 3% makes absolutely no sense to me at all.
And so we've had a sell-off. It kind of touched bear market territory almost, depending which index you look at, down 20%-ish. Coming off the bottom now for a number of indexes and a number of sectors. What are you doing with cash? Are you sitting on it? Are you putting it to work?
No, I'm putting it to work because, what I've learned, having gone through these cycles multiple times, and each one's different, obviously, it's impossible to time the market. And so I distribute about 6% a year out of my trust. So I'm always looking to make north of that, or at least that. I'm not going to do that with fixed income right now. So I'm looking for really high quality companies that either have one of two things: great balance sheets, are generating a lot of cash and distributing it through the form of dividends or special dividends to me as part of my distribution. So that's very important. But also I want growth. And what's so remarkable about this market correction on certain equities, growth has not stopped. There are some great companies out there that had their PEs compressed, the price earnings ratios, but their growth rates haven't stopped. And so it's time to go tiptoeing through the tulips and put money back to work, not knowing with certainty what happens next. But if you looked at 2000 or 2020 and you looked at 2021, you had the majority of your returns in less than 25 days. You just don't know which days. And that's always been the case in volatility. And so to try and time the market is a fool's errand, fool's game. You can't do it. So you have to deploy whatever percentage you want in equity and find the best ones to own, and then just wait. You don't know what's going to happen. But over the next 18 months, I see a lot more volatility. But again, it'll be the same thing. The returns will come in a handful of days.
Yeah, so you got to be positioned for the upside before it happens, because obviously after it happens, it's too late. You kick yourself and say, I should have, would have, could have. Let's talk about heavily levered companies for just a second. This is, again, not in our set agenda, but you made a comment there about owning high quality companies. Interest rates are going up. Leverage is tougher to handle when you get high interest rates. A lot of companies borrow short term, so they're living at the LIBOR end of the curve. What's that going to do for the more levered companies?
Well, the market's already spoken. Levered companies, particularly ones that have no earnings, have been crushed down 60, 70, 80, 90%. The market's not willing to pay for forward dreams at all. So that puts you in a place where you really want to find companies that have less leverage, stronger balance sheets, but above all have earnings and are generating cash and redistributing that back to shareholders. That's a very good place to be, so to speak, hide out in the weeds for the next 18 months. That's the kind of thing you want. Either you're taking your risk on the side of quality or you're taking your risk on the side of growth. Growth is also good, but having a speculative holding that doesn't make any money, that has a lot of debt, the market has already made its decision. It's taken that out behind the barn, and you know what happened to it.
Yeah, obviously tougher to get through an economy, if it's a slowing economy and your business isn't great and you got a lot of leverage, you've got a series of problems. All right, so let's show people the agenda for today. We'll just go to that invitation checklist there. So we're going to talk about the valuation. This is all about tech stocks. We're going to talk about the valuation situation now, what upside there might be. We're going to talk about revenue growth rates. We're going to talk about some key sectors. We're really going to drill into cloud and just talk about that, including some of the cloud components that are in the OGIG index. And then we're going to have a discussion on investor strategies and advisor strategies, taking a look at the different type of tech opportunities or investments for those that are considering positioning for what might be, a rebound that may have already started. But let's go to the very first slide. And Kevin, here we have a slide that's the update of our research that you've seen many times. We've updated it showing the importance of revenue growth in the tech sector. So it's all the tech stocks that are in the tech sector, and we basically rank them by quartile according to their 3-year revenue growth. And then the numbers you see at the top of the bars show quite clearly that first and second quartile revenue growth ranking stocks have the strongest returns. And every time we update this, it tells us the same thing, that tech stocks with revenue growth perform better in the equity markets than those that are in the third, fourth quartile of revenue growth. What do you see in the real world that really demonstrates why this is actually the case every time we update it?
Because during the pandemic and over the last 3 years, the economy has changed globally. It's moved to the cloud, it's moved direct to consumer, it's moved to digital forms of communication. And all of that is generated by these companies. And basically what happens is these are the infrastructure utilities that the rest of the S&P use to actually conduct their business. And a great example that's easy to understand, and I use it all the time, is Nike. Going into the pandemic, Nike was less than 50% direct to consumer globally. It's a behemoth. Everybody knows the brand all around the world. Today, and they did this in a matter of about 8 months, they're way past 50%. They sell direct to consumer, whether you're in Phnom Penh, Cambodia, or in New York City. Doesn't matter. You can order your sneakers delivered right to where you live. Now, to be able to do that, you need a really strong command of the cloud, digital information about your customer, AI, data mining to know what size, what color, what preference, when these people purchase. All of that is integral. And that's what these companies do. They provide that kind of infrastructure. But it's not just Nike. It's every single company that's come through the pandemic successfully has built a very, very strong direct consumer business. And in Nike's case, you just look at all their retailers, the Foot Lockers of the world and all the 1,200 square foot strip malls, stores, they're all on the decline because all of this technology, the cloud-based services, direct to consumer, social media, digital advertising, all of that continues to grow. Now, the market has decided because of volatility that they're going to pay less for this growth, but the growth hasn't stopped. The need hasn't stopped. The digitization of the global economy hasn't stopped. And so as an investor, you have to hold your nose into this volatility, but this is where the growth is. These companies are growing at absolutely extraordinary rates.
And so it's really interesting that the growth rates are that much stronger in some of these categories, and that's what's driving stock prices. I guess it's kind of common sense, right? If your revenue is growing much faster, you're probably a more valuable company than the one whose revenue is growing slower. So thanks for that, Kevin. Let's talk about valuation in the tech space, pre-COVID, post-COVID. I love this chart. It basically shows us two lines. The blue line shows the valuation ratio, price to sales, of the OGIG index, so all the stocks are in the OGIG index. And the gray line shows the same price to sales ratio for all the stocks that are in the NASDAQ 100 index. Pre-COVID, so let's go November 19th area, you see those arrows, and it shows you that at that time, the price to sales ratio was 3.4 times for the NASDAQ stocks, and 3.8 times for the NASDAQ stocks, 3.4 times for the OGIG stocks. What has happened is that all of the stocks got more value, all stocks got higher valuations through the COVID period. And so you can see the blue line went quite high, up to almost 8 times. And then the sell-off occurred and it went down to about 3.4 times. Whereas for NASDAQ, it went from 3.8, it went up, and then it went back to 3.8. So here the point is, if you say, okay, what if valuations go back to pre-COVID levels, how much upside do you get out of the NASDAQ 100 index? You don't get any because it's a similar valuation. So valuation recovery as a multiple doesn't change much for the NASDAQ. Whereas for the OGIG index stocks, a valuation multiple recovery takes you from 3.4 times back to 5.4 times. And that would be about 37% upside just on that valuation ratio. The other thing that's happening is all these stocks are related to businesses whose revenue continue to grow. And the revenue growth rate is even stronger for the OGIG stocks than for the NASDAQ stocks. So Kevin, how do you think about differentiating between the NASDAQ type of stocks, the NASDAQ index, and the OGIG index?
Well, there's a significant difference, and it boils down to growth. I mean, NASDAQ companies, there are some dinosaur companies in there that are no longer growing. I mean, that's the challenge. So the QQQs, for me, is not the place to go if you're looking for the new technologies and the higher growth companies, and they're global as well. So, you have to decide if you want legacy, that's fine, except you're not going to be rewarded with growth. And so obviously, I think over time that PE is less. It's going to remain less because people want growth. That's what they're looking for. And the economy changes dramatically. And we've had a fundamental shift in the digitization during the pandemic. That's not reflected in the Qs, as I call them. I don't use the Qs for the growth portion of my portfolio. I use OGIG because basically the companies inherent in that index are growing faster. And that's what I want. I'm looking for growth. And the market values those based on some very simple ideas: growth, growth, and growth. That's what matters. And so if you're a dinosaur behemoth stuck in the Qs, you can't provide much growth to that index, and you may be fully weighted in there. So that is always going to be a problem. The Qs, I don't think, will ever represent the new technologies of growth. It doesn't catch up fast enough.
Two interesting points about the NASDAQ 100 index. One that everybody probably knows, and another one they maybe don't. The NASDAQ 100 is very concentrated. The top 5 or 6 stocks dominate that index. The second point, and I'll just ask the producer to put on the slide again of these line chart, preceding slide. You can't see it in here so clearly, but if you look at the very right-hand side, you'll notice an uptick in the blue line. And if you actually go to your screen as an advisor or investor, take a look at what's been happening with the upside on up days for OGIG index versus the NASDAQ 100 index or the related ETFs. And you'll see that actually on up days, OGIG has now been doing far better than the NASDAQ 100 index, which suggests there's a lot more perhaps upside in that index, in that family of stocks. What's also interesting is on many of the down days, and they're going to continue to occur, you actually see somewhat similar or lesser down days on the OGIG side. Why might that be? Maybe they got very oversold. So maybe the people who actually understand those companies are now more buyers than sellers, and maybe that's what's causing that dynamic. When you look at the up capture, down capture ratios, we'd be happy to send this to people who ask for it. You actually see favorable comparison where the OGIG index actually has better up capture, down capture ratios than the NASDAQ 100 in the recent days and weeks. One more slide to show people the bar chart right after this, just so people really understand the composition of the portfolios here. So OGIG index is the tall blue bars, NASDAQ 100 is the shorter gray bars. And what it shows is the revenue growth rate, actual revenue growth over all those quarterly periods for the 12 months preceding each quarterly bar. And what it shows you is the OGIG stocks have been growing at an increasing rate. Their businesses are growing at an increasing rate now at 50%. What it also shows is that NASDAQ stocks or companies have a growth rate that is actually only 30%. And actually, if you look closely at that last couple of hours, the NASDAQ 100 stocks in the aggregate may be drifting down in terms of the growth rate. So that's the closing point on why revenue growth, valuations about the OGIG stocks compared to the NASDAQ 100 stocks, and a health metric here, how well are they growing their revenue? So thanks very much for this discussion, Kevin. I'd like to move to another topic, which really is an update of the OGIG index or portfolio update. And this is as a very recent date. We show the various different industry components. And I really want to highlight for people the allocation within the OGIG index to enterprise software. This is cloud, cybersecurity, data infrastructure services, and more. 49% of the OGIG index. Look at the third column, TTM revenue growth, trailing 12-month revenue growth, 57%. Forward revenue growth in the next two columns, 37, 28. And finally, on the 3-month change, revenue forecast by the Bloomberg aggregated forecast, positive. So lots of growth being revised slightly upward 49% of the OGIG index. So we think it's a very interesting way for advisors and investors to own a diverse selection of enterprise software, cloud, cybersecurity, data infrastructure companies with these growth rates. Kevin, in your industries, your businesses in which you invest, how much are they using, how much are they spending within this category?
It's our fastest growth category in terms of how we spend dollars off the income statement. Any company that is not taking advantage of cloud-based services is going to lose out to competitors that are. I mean, it's so important whether you're doing commercial kitchens. I'll give you an example. Wicked Good Cupcakes, a company everybody knows from my Shark Tank deals, is now using the cloud to determine what flavor preferences are in what regions. The same with my wine business. Moscato wine is the top seller right now in Florida. We know that because we're tracking orders by the hour. So we're preparing for the fall season, more of that sweet wine, because that's what the consumer wants in that state. This information is all cloud-based. It's all done there. And so we hire these seats and we buy these services and we lease these services in every situation we're in private business. And it's the same for giant behemoths in the S&P. You can't compete without this information. I don't care who you are. And so this will continue to grow. There's no question about it. And in the unfortunate situation that's going on in Europe, I point out to everybody in the Ukraine, countries and sovereigns and states and provinces and the Mexican provinces and everything else are now looking to put their cloud-based services, their nexuses and data centers on their own soil so that they have their own information in their own country. And that is really blowing up these services even faster. So, people don't want their data centers in the Ukraine because a Russian tank's going to roll over it. They want it in the state they're in Montana or North Dakota or New York State or in Ireland or in Switzerland. And so the amount of these services that are nexus directly to sovereigns is growing geometrically. These companies are on extraordinary growth paths.
Let me show you the next slide here, and then I'm going to ask you a question. So this is the forecast, again, aggregated by Bloomberg, that shows expected growth of spending in cloud infrastructure, SaaS, data storage, computing, networking, etc. They break it in two categories that seem to have comparable growth rates, almost an even split here between the infrastructure plays and the SaaS applications. And you see this phenomenal growth from $400 billion to $1 trillion of spending. It's been growing fairly steadily. It's now forecasted more than double over these years. What is it about businesses that causes them to not cut the spending, but just keep on increasing the spending? How is it that they don't have enough choices with, let's call it, cheaper sources of that same service, and instead they just keep spending more and more?
Standardization, training costs. These are some of the biggest issues. When we bring a new employee on to one of our private companies, we want them to be trained on the same service or utility that everybody else understands that already has been trained on. So you're making an investment in time, in employees' time. And so you standardize on Salesforce, you standardize on Google, you standardize on Microsoft Teams, whatever it is, you standardize on Zoom. We've probably bought more seats on Zoom than anything over the last 18 months because we've used that as a standard in how we communicate directly with our buyers and our marketing teams and our social media people. And all of these things become standards, and those companies hold on to their customers and they grow with their customers as the businesses grow. But I don't think we've changed platforms in 3 years. We don't want to relearn anything. We stick with the standards, and those companies become huge. 36 months ago, nobody knew what a Zoom was. Now it's like Kleenex. Everybody talks about it around the world. That's just one example.
And the switching cost is really the reason, I guess, that people don't switch, just too expensive. And actually, these companies don't charge their clients all that much. They just have a lot of clients, and that's why they grow. And we know we spend a lot of money at our small business here, and we don't switch suppliers. One more slide here on cloud. I want to show people here because it shows how the OGIG index works, and in terms of what kind of cloud-related stocks get selected and included. It is not every single one of them, but it is a set of stocks that comprise 56% of the global market in terms of their total revenue. And so what I want to explain to people is that the stocks are selected first because they're in the right sector that qualifies, second because they have quality balance sheet and profit margins, and then third, very importantly, they have strong revenue growth. And our research shows that revenue growth really, really matters across the technology sector. So here we have these companies, the blue slice of pie that is almost a quarter. It's quite a range of SaaS and cloud-related companies. Below that, a list of names that you all know: Microsoft, Amazon, Google, Alibaba, Tencent. And then the big blue piece is cloud-related companies that are not in OGIG. Why are they not in? Because their revenue growth rate is lower than those that are in. That's the primary reason they get excluded. So Kevin, you look at this pie chart. What is it about the pie chart that maybe excites you as an investor using the OGIG index?
Because it reflects the new economy. It reflects what's happened over the last 3 years. It reflects where goods and services are moving to on a digitized basis. And these companies are showing you that they're successful by just their quarter-over-quarter growth rates. I mean, this is not a speculation. This is a fact that the economy has changed all around the world. It was out of necessity that this occurred. And it really is reflected in this pie chart in terms of where goods and services and dollars are spent in supporting businesses in all 11 sectors of the economy. I don't care what sector you're in. You can be energy, auto, consumer, or biotech, or whatever. It's all basically gone digital. And these are the companies that provide that infrastructure. And so in terms of any diverse portfolio, you want to reflect what the economy is doing. You want to be part of that growth. That's how you achieve what the market gives you in terms of economic growth. And this is a big sector, a very important sector. It obviously is providing services to every sector because everybody needs these services, and it's reflected in the OGIG index.
Now, how do you feel about using an OGIG index that excludes almost half of the companies that are in this space, that big piece of the pie chart, and including those that are 56% of the global market, but not all of it?
No, I'm happy to do the exclusions. If they're weaker, they have weaker balance sheets, or they're not growing as fast, or they're not market leaders, I don't see any reason to own them. You don't have to speculate that way. You want the behemoths. You want the ones that are successful, that have momentum and have geometric growth. That's how you should index them. That's what OGIG does. It's like the difference between owning the NASDAQ 100 and owning OGIG. The NASDAQ is anchored by all kinds of dinosaur companies that reflect yesteryear's economy, not today's. And so you want to capture the growth that the new digital economy is putting forward.
Got it. Well, thanks for that, Kevin. We have one last segment I want to share with advisors, investors. This is really kind of a strategy slide, give people something to think about here. We have 3 well-known indexes that are represented in these summary statistics. And it's a comparison of these key summary statistics across the OGIG index, NASDAQ 100 index, and the tech select sector index. Just summarizing some points, the OGIG index has a 75% active share, meaning differentiation, different stocks and weightings than the other 2 indexes. It has a valuation that is actually lower on a price to sales basis, with almost double the revenue growth. And when you look at valuation potential upside, just going back to pre-COVID levels, pre-COVID price to sales ratios, the OGIG index would be up 37% when it gets back to those levels, whereas the NASDAQ 100 index and the tech sector index are actually already at about the same price to sales ratios that they had prior to COVID. Now, the stocks might be a bit different price because the sales is a bit of a different level across all these as well. When you think about sales growth, well, it's growing faster for the OGIG index at about 48% instead of in the 20s for the other 2 indexes. And the forward revenue growth, again, OGIG almost double the forward revenue growth of the other 2 indexes. So Kevin, what do you think this represents, not just to you, but to advisors and investors, and how to think about positioning their allocation to technology?
It's all about the active share. In other words, how different is it from traditional indices that are I'm not going to say mired, but have too much legacy in them that isn't growing? Because the economy changes quickly, as evidenced by what happened over just 36 months during the pandemic period, the companies that emerge out of that, so many of these companies indexed in OGIG were names that you didn't know prior to the pandemic. But this massive shock, this digitization, this cloud-based servicing, this entire move direct to consumer all around the world is reflected in OGIG, which is essentially an index that captures growth in the new economy. That's basically what this information tells you. And so it doesn't have to be the only index you own, but its active share tells you you should own some of it because it's so different than so many of the legacy indices that don't capture the growth we've been talking about. It's about the growth. It's about the new economy and it's about the size of these companies, their balance sheets, and their quarter over quarter growth rates that are just extraordinary. You don't see this anywhere else.
And so the OGIG index gets investors and advisors an allocation to stocks that they can't really find in the more traditional tech indexes. So yeah, it's maybe not the only tech allocation, but it's potentially a very important one for people to consider. I just want to explain to people how to get more information on the topics we've covered, and then I'm going to ask you for a closing comment, Kevin. So we just showed the slide that just is called the call to action. People, first, thank you for joining us. Second, to get more information, there are two things you can do. You can request the full cloud market breakdown of the OGIG index and more by sending us a note, info@oshares.com. Request that, we'll get that to you, and particularly for advisors. We're able to provide quite useful, we hope, very interesting information. The second thing you can do is set up a call with our Director of Capital Markets, Kevin Beatles, and he can provide further discussion and more customized information that some people might like to have. So that's the thank you and the call to action, so you can all get more information from us. We do a lot of research. We have a wonderful investment team that digs into the data to try and find out what's really, really making stocks and indexes move. So thank you. Kevin, closing comment for you here. You know, the market has sold off. The market has bounced a couple of times. Is this bounce the one that's for real? Is this the turning point? What do you think for those people that actually are hoping that it is or waiting for the right turning point? I know you're not a market timing guy, but what is your thought about what could be different about this bit of upside versus the past ones?
It's the volatility in the market, because the market just doesn't know. Nobody can time the market. It's impossible. The best strategy here is to own the names that are growing and own the best balance sheets you can find and have a lot of diversification, which is basically how I do it. I don't know if this is the bottom. Nobody does. And forecasting, it seems futile. But the key to know is look at the past to guide you in the future. Go back in any period when you've had volatility in the market or the threat of a recession or Fed raising rates. All of these things have happened before. Returns in the market come back in a set number of days. It is not equally distributed over the days of the year. They're very intense, sometimes violent moves to the upside and downside. And if you're not in the market, you do not achieve the returns the market gives you in that calendar year. So the only strategy that works is to really groom your portfolio towards quality and names that you know are growing, and hold steady and be there in the market on days that it's up. And unfortunately, you're going to be on those days where it goes down, but you layer into the market. And that's the only great advice anybody can give anybody that's been a market observer. It's impossible to time the market. Don't try. I don't know anybody that's been successful doing that over a long period of time.
So it's discipline, 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 and know what your portfolio allocation should be for yourself, for your clients, and to proceed accordingly. Thanks very much, Kevin. Appreciate the time, and thank you, everybody, for joining us today.